Sorry, guys. We're running a few minutes late, but we're on. I'm just going to pull up his slides and we'll get started.
Hey, Jessica, did you register them or you did? Why did you take
Am I gonna? No, we're already. Name the artist. It does that. It takes a few minutes for it to brighten up. Yeah.
Where's your email?
Do you want the other one? This way I have them all. But...
Okay, good afternoon, everybody.
Good afternoon.
So we got a good mix of people here. We got some new agents, we got some seasoned agents. I've kind of done this over the years, but I wanted to kind of bring everybody back to zero because we're still getting a lot of questions about appraisal stuff. Is this a good financing transaction? Which offer should we take? And it doesn't always apply as far as a cut and dry kind of answer to everything. So what we're going to do is we're going to go over like the different type of financing for different buyers, things that you're going to see on different contracts. Then we're going to talk about appraisal stuff and concerns with different types of financing. And then we're going to talk about kind of the rate environment that we're at right now too as well. So I always get the question, the day-old question, Anthony, you know, which offer should I take? I have an offer that's a conventional loan with blah, blah, blah down. I have an FHA loan. I have a VA loan. What's the best loan? Well, I mean, the truth of the matter is there's all different types of mortgage programs that people are eligible to get financing on, right? But when you're buying a house, every program is not for everybody. Why is it not for everybody? Well, some have different restrictions and requirements, different down payment requirements, which are important to know. So we're going to kind of break down kind of like conventional financing and FHA, because those are the kind of two main programs that most buyers typically utilize when financing a house. And we'll kind of go over the pros and cons and different things that people are doing. So in regards to conventional financing, okay, the properties that we're financing are typically 1 to 4 unit homes, condos and townhouses. Anything considered over a 4 unit is going to be considered either mixed use or commercial, right? So if you have a 6 unit apartment or an 8 unit, different type of financing. I can't help you with that. Typically, they're going to be working with their business banker, like a bank relationship, because it's a different segment of the business. Mixed use property, if you're not familiar with it, is when you have storefront down below, residential space up top. Conventional Fannie Mae, Freddie Mac does not allow for that type of financing. FHA does, but at a light use. They look for at least over 50% of it to be residential versus the mixed use or commercial piece of that. So that gets really kind of wonky a little bit when we're trying to get
So would
financing.
they go into a business bank for that also?
Potentially, depending on the variation of the percentage owned of commercial space to residential space. So whenever I have a client that's coming to me saying, hey, I'm looking to buy a multifamily, but it's a mixed use, the first thing I'm asking is, of the square footage of the property, how much is residential space?
And is the business rates cheaper or more expensive?
Usually more expensive. Down payments are more expensive. A whole different type of qualifications go in. Exactly. I don't specialize in it. So conventional financing, 1 through 4 unit owner occupied or investment properties or second homes as well. You can't buy a multifamily second home. Buyer qualifications. It's solely driven by credit score and qualifying ratios. Ratios being your debt to income ratio. Debt to income ratio is when you take your total monthly debt, monthly payment debt, plus the proposed mortgage payment, dividing that into your gross income. That's your debt to income ratio. Typically, Fannie Mae and Freddie Mac, conventional financing, they don't really want you exceeding 45%. However, though, we can get those approved up to 50% at times with larger down payments, with credit scores, etc. Seller's assistance or seller concessions, as you guys know them, it varies on different LTV and occupancy. Typically, if you have buyers that are doing low down payment like 3%, your maximum seller concession is only 3%. So keep in mind, whatever the closing costs are, your concessions are going to trump that. So if you have a borrower that's buying a $300,000 house at 3%, that's $9,000. But if the closing costs are 12, they can only get up to $9,000 because it's the lower of the two. Putting large amount downs like 20%, you could actually get up to 6% seller concession. But again, it's whatever the lower of the two. Down payment options, like I just mentioned, 3% down. So a lot of times people always say like, oh, they're only putting 3% down, they're going to convention. I mean, FHA, excuse me. But why not go convention? As a first-time home buyer only, you're allowed up to 3% down as a minimum down payment. If you're a subsequent buyer, you owned a home in the last 2 years, conventional Fannie Mae, Freddie Mac requires you to put down at least 5%. Yes, Carol.
If it was really about my granddaughter, she's married to someone who has been married before.
Okay.
Can they still go with the 3% down?
If one of the two applicants have owned a home in the last 2 years,
No,
it's got to be 5%.
not in the last 2 years.
Then you're okay. Because they deem that within the last 2 or over 2 years, first-time home buyer once again.
Okay.
I have a question on what's the criteria to determine whether it's an owner occupied or not, now that you can work remotely?
So it's, are you going to be living in the dwelling, right? Are you going to be occupying this as your primary home? So it doesn't matter that if you're working remotely, but are you living there, right? So someone can work for a San Francisco-based company and live in New Jersey and work remotely. Are they occupying that as their residence, or where they're going to occupy the home? What's deemed an investment property or non-occupied property is something that you're not going to live in, that you're going to rent out to somebody else, right? Where second home comes in is something that's typically in an area that would be more of like a second home area. The shore is considered a second home. The mountains are considered a second home area. But if we live in Randolph, no one's buying a second home in Roxbury because you're not going to vacation there on the weekends. That's going to be considered an investment property.
Now the rates.
Yep.
The rates are
More expensive on investment properties because of the risk. The risk at that point is, God forbid if something were to happen, and this happened to us 15 years ago. Everybody saw this as clear as day. Many people bought investment properties during the crazy times of the mid-2000s. There was unbelievable mortgage programs that were allowing people to buy very cheaply or with no money down on investment properties. All of a sudden, the market cleansed itself in 2009. And what would be the first property you're going to walk away from if things got tough? It would be your investment. You're not going to kick you and your family out of your primary home to hold on to an investment property. So that's why we saw those foreclosures kind of go up on all those properties that people had no skin in the game. Fast forward, here we are all these years later, investment properties, at least 15% down on a single family. Multifamily, 25% down. So, you start getting a lot more people vested in the transaction. So you're required to put a lot more down. And sometimes, you're going to require to have reserve requirements. Well, typically, most of our buyers that are buying a primary home, there's no reserve requirements, like assets after closing. If you have multiple properties, sometimes they're looking for 3 to 6 months worth of that monthly mortgage payment as a reserve. So in case, God forbid, you had some challenges, you have some money in the bank. Yes.
Say you have a house, pay it off.
Yep.
You own that house.
Yep.
You want to buy a house down the shore.
Yeah.
Consider it vacation.
It would be a second home. So the good thing about second homes is,
Can I make that my primary?
I mean, you can if your intention is to move there. So there's a lot of people that say, listen, we're looking to retire, right? Living up here in North Jersey, we're looking to go down the shore. We're going to flip flop the properties. Maybe you're going to rent out the one up here. That's totally possible.
You still qualify as first time buyer.
No, because you still own a property regardless if you have a mortgage. But again, with second homes, though, the rates are still equally as good as primary homes. And the only requirement down is 10% at that point. You don't get the 3 or 5, but it's a 10% requirement. Mortgage insurance. Everybody's always heard this terminology before. If you're buying a house and putting less than 20% down on a conventional mortgage, you need some form of PMI or private mortgage insurance, right? Now, a lot of times people say to me, what do you mean some version of PMI? Well, there's different options for private mortgage insurance. Most of the people out there take the monthly PMI or borrower paid monthly mortgage insurance, which means when you put down less than 20%, you have to pay a per amount every month. It's based on a certain percentage and factor. And what goes into that qualification is based on your down payment and your credit scores. So far, better credit qualified buyers, the PMI is very low. So that goes back to a lot of always the questions like, oh my God, I don't have 20% to put down. But if your credit's excellent, the PMI is not that bad. And they changed it about 3 or 4 years ago. The PMI rating company said, hey, listen, why are we going to penalize someone if they're not putting 20% down? But if they got good credit, we're going to bring those numbers way down, which they did. But if your credit is not great, it's much more expensive because of risk. Now, talk about the variations of private mortgage insurance. Besides it just being part of your monthly payment, or once you get to that 20% equity, you could actually have that get removed, right? What you could also do too as well is you could finance your mortgage insurance. But these are getting more into the questions for me with the customers, like how long are you going to be there for? Because let's say if someone's going to pay $12,000 in PMI over the next 9 years, right? At $100 something a month times 120 payments. What if they can buy it out up front for $6,500? Just to use kind of give you numbers. You're actually taking that and financing that on top of the loan based over 30 years. So rather than paying $175 a month in PMI, maybe we increase the loan by $25 because of what we just added on top of the loan. That's actually a better suited program for them because their payment's cheap. Where it doesn't make sense is when people are looking to like, hey, I'm going to come back to you in a year because I'm going to refinance. Well, we just financed $60-something $100. Your loan balance is now higher by that amount. If you refinance, your payoff is higher. So it's not for everybody. It's based on certain types of programs. And then there's another version of PMI called lender paid. And at that point, we're increasing the interest rate higher to avoid the monthly private mortgage insurance. But again, not for everybody, because if you're basing it over 30 years, your interest rate is much higher over the 30-year period. We don't really do a lot of that. I do usually a variation of the first two. Whenever I have like borrowers buying $400,000 to $600,000 houses, the single premium or finance mortgage insurance is a great option for them to be saving $150 to $200 a month.
Will they take the Realtors market analysis to show that the house has increased at 20%?
No, so what happens is if you're a buyer and you own a home, and let's say you're in for 2 or 3 years and we just went through the market we just did. Buyers are doing one of two things. They're either coming back to me to refinance because maybe the rate's actually better than what they took out at, and to potentially get rid of the PMI because now we have a new value. Or they have an option to go back to their lender and ask for them to get the PMI removed based on the current environment. The lender usually gives them an option and says, listen, you have to pay for an appraisal on your own and let the appraiser determine what your current equity position is. And if you've been in a loan for at least 2 years, Fannie Mae and Freddie Mac asks for a 2-year requirement to be paying the PMI, they'll remove the PMI. So there's a lot of different options when it comes to that stuff. And these are things I always go over.
taking the phone away.
That's okay.
It's going on the office page. Office meeting. I mean, the
Scroll
office
down there.
page. Relax. It's just freaking going on the office. So what do you want me to do?
Just scroll down. One slide there, sorry.
You want to stop taking pictures? Yeah. You want to- Yeah.
No, I got the piano off my daughter.
I don't know how to do that.
You're
People,
good.
apparently, I don't know how to do that. Meanwhile, people see my face right there, who's on Zoom.
And again, this talks more about, the 78%, it automatically cancels, excuse me. The PMI automatically cancels out at 78%, but you can call up your lender and request it to be removed earlier at that point too. Let's- No, so we're gonna talk about FHA, and this is where the pros and cons come in for buyers, right? So like, what's the difference? There's two different type of programs when the main guts of what we typically do financing on. The next thing is gonna be about FHA. So FHA, similar to conventional, you don't have to be a coach.
Excuse me. So those strategies you were explaining before, when do you think is the best time to introduce those different strategies with?
I'm gonna circle back on the two programs because we're gonna do a quick comparison when we're done. So on the FHA loans, it has to be a primary residence. So you can't be an investor, buy a second home through FHA and the government financing. It's only for a primary home. They allow any buyer, subsequent buyers, 3.5% to put down. So very similar to like a first-time home buyer in the convention, right? So a lot of times when I'm going over the different options to customers, and like I was even mentioning on a call recently, FHA allows for 3.5%, conventional allows for 3%. So it's very similar. They allow actually for higher debt to income qualifications, 50% even higher. FHA allowed you to go to 56.99 on a debt ratio. Okay, that's their guideline. We go right to the max for them. The big key factor is on that is just keep in mind, you're going way above the threshold to get someone to qualify. Okay, it's not a guarantee they're always going to approve that, but when we run the findings, we determine that. So a lot of times when people are getting out of their comfort zone and trying to really push the envelope, this is where FHA starts to become a little bit more attractive for certain buyers because they're able to afford more. Now, yes, they are kind of getting out of comfort zone or getting away from the conventional guidelines, but this is where the program at FHA allows them to qualify for more finance. Regardless of the loan to value, they allow up to 6% seller concession. But again, keep in mind, it's whatever the closing costs are, whichever is less. But for example, some of the deals we have where the tax is like $15,000 and stuff like that, you can get a seller concession picking up a $15,000, $17,000 closing cost on an FHA. It's a pretty good deal, especially because we're seeing that a lot where buyers are landing a deal and there's some challenges with the property and they're trying to max out the seller concession. I get messages from attorneys all the time. What's the max seller concession we're allowed to do on this? Because they need to know whether it's at 3% or it's at 6%. VA loans are 4%. We'll talk about that in a second. FHA requires an additional fee. So this is where the pros and cons start to come in. FHA requires 1.75% of the purchase price. That goes right to FHA. That's not a WICR fee. That's not a real estate fee. That's a FHA fee. That's right to them for saying, if you want to use an FHA loan, we have our skin in it too as well. We need to get some money. So that 1.75%, buyers can either pay a closing as a closing cost, or they could finance that on top of the loan too as well over the 30 years. And that's typically what most buyers do from an FHA loan. They file that. So you have 1.75 there. And the other key thing about FHA is the mortgage insurance. It's on there for the life of the loan when you're putting a lot of money down. So a lot of times people always ask me, what are your pros and cons? I always tell everybody, and this is to you guys too as well, whenever we're doing a pre-approval for someone, I always aim for a conventional loan first. Fannie, Freddie, conventional loan first. I use FHA as my backup or my last option if I have to, for reasons like this. A lot of buyers are concerned or hip to it about mortgage insurance. Like I don't want to pay mortgage insurance forever. Well, keep in mind, if you're putting down 3% on a conventional or 3.5% on an FHA loan, if you're going to make your organic mortgage payments, your regular payments every month, it's going to take you like 9 or 10 years to build in that 20% equity. If your goal is to maybe refinance down the road, the FHA loan might be the best option for you if your credit scores are not the highest, or maybe you might have had some blemishes in the past too as well. Yes, Deb.
Not if it was the building projects. All the houses went up a lot,
Oh, of course.
a lot.
Of
So you
course.
probably could have refinanced that PMI loan.
I mean, I've done so many refinances over the last year and a half for clients that I've done only 6 months prior to because of home value.
Do they have to wait 2 years after that? Before they can refinance?
No, you could refinance right away. Absolutely. Can you scroll that down?
Mhm.
And there's that little top part there. The PMI usually does not fall off of that. Let's talk about VA loans. We talked about them a little bit this morning in our meeting. VA loans are probably one of the greatest loan programs out there for the veteran. Okay. No money down option. Literally, you don't have to put any money down. There is no mortgage insurance for our veterans. So just like the different from the PMI on the conventional loan and the FHA loan, there's no PMI. What does that mean? The borrower qualifies for more. They're not paying on a $500,000 loan, $200, $300, $400, $500 a month in PMI. Well, $500 a month in PMI equates to literally almost $100,000 in buying power. Think about that, right? If you're an FHA buyer and you're paying $250 a month in mortgage insurance, that's about $50,000 in buying power. So your VA buyer, in essence, would qualify for it when it comes to that. The interest rates are ridiculously low for the VA buyers. There's no mortgage insurance. You're allowed a 4% seller concession maximum on the VA loans. I mean, there are VA buyers out there, maybe not as much in this marketplace as in previous markets too, where literally no money down, requesting a seller concession to cover all their closing costs. They come into the transaction with not a dollar. Literally, the only thing they're paying is their inspection and appraisals. And that brings me to like some of the concerns and questions that everybody always has. You know, which offer should I take? I have a conventional, I have an FHA, and I have a VA. Yes.
Can your non-VA spouse be on the VA loan with you?
As long as they're,
Get a bigger
as long as you're married.
dollar.
As long as you're married, that's the key thing. So the boyfriend, girlfriend, one of them being the vet, doesn't fly with the VA. Engaged also doesn't fly with the VA. It's got to be a married. And it's tough when it comes to that, you know, unfortunately. They're pretty rigorous on the guidelines.
Anthony,
Yes.
yes. Look at it as positive for VA compared to something else, because now I'm looking at it differently. Maybe they'll be great hope that we're getting the house and not putting a penny down.
Well, that's what I was
And
going
they'll be a little bit better with home inspection.
And that's what I was going to go over to as well. Like when you start looking at conventional financing, FHA and VA, right? As a seller side, if we look from that side, that's always the question I get. You know, which one should we take? You know, this one's FHA. We're going to talk about FHA appraisal in a minute, or government appraisal in a minute. But a lot of times on conventional loans, you're going to get the gamut from 3% to even 20, 50, 70% down. Well, as a seller represented agent, you know, you guys know which deals look the best, right? If you're someone putting 50% down versus an FHA or VA at 3 or nothing down, well, maybe that conventional deal appears to be a better option. You guys know what you need to do in speaking to a seller saying, yeah, but the VA wants 30,000 more. You know, the seller's already holding on to that money, right? They want that money. But you got to look deeper through that. You got to find out what works for the seller, what works for the buyer. Is it going to be a challenge? Is it going to be an issue? Are they waiving certain things, right? Because you could be a VA buyer with no money down, but they might have $100,000 in the bank. They're exercising their right to utilize the program. You know, I mean, just because they're VA doesn't mean they have no money.
The VA is so tough with their qualifications on how the house has to be almost perfect.
We're going to talk about government appraisals in a minute, right? We're done with this because that's the big concern when people are talking about this. They're always concerned about the condition of the house. And for me as the lender, when I pre-approve a buyer and we are talking about government loans like FHA, VA, I'm always running to you guys. Tell me about the house. I can see this in the house. What's that in the corner there? Oh, well, you know, there's a patch here. It could be a problem. You know, if the house was in really rough condition or something, chip paint could be a problem. We're going to talk about that in a minute. I don't want to jump the topics. But in the VA program, it's a fantastic loan program. It's great. You know, sometimes some sellers and buyers connect. You might have a seller that was in, you know, Vietnam or something like that. You know, wow, they want to do the right thing. The whole love letters we've kind of gotten away from over the last year because it's kind of like a frowned upon thing. But as a veteran, I've always told them, try to connect with the seller as best as you possibly could. You have an American flag in front of the house.
How about put some money down too?
Well, so that's another thing too as well, Deb. Thanks for bringing that up.
I agree with the percentage.
In purchase contracts in general, regardless of your down payment, I always recommend people to try to put as much money as you can down up front versus leaving money for closing. But on a VA loan, you're putting no money down. But if you have some money in the bank, why not put it down as a security? We can do an addendum during the process to get that credit back towards closing. So if someone's putting down, hey, I'm gonna put down 10 grand up front, but the closing costs are 12, well, they'll just bring 2 to close. You know what I mean? So at least it shows from a seller standpoint, oh, they do have some money, right? Keep in mind, if a deal falls apart and it falls apart in AR or inspections, your buyer's gonna get his money back anyway, just like you're explaining in your regular contracts. So I always try to tell people, rather than breaking up a 10 now and 5 tomorrow and another 12 at closing, go in best foot forward if you can up front, because that's super key, especially. Because the unknown is everybody always kind of sees, oh, nothing down. Ugh, I got nothing to hold these people here. You know what I mean? So, you know, you guys are doing all this right thing. But, you know, these are great programs for people. That's why they're available. You know, that's why they're available. Just notes.
You know what it is too? It's the COVID market is so crazy. You're only the best buyer in there. So it's hard to make a VA or an FHA that down for free.
Listen, I think the pendulum is starting to move a little bit, where I'm getting some FHA buyers accepting offers right now, but it's been tough the last year and a half. There's too many over-aggressive, competitive, conventional, big down payment buyers out there, cash buyers. You know, that was always the big fight, right? Cash deal transaction. Oh my God, we're getting a mortgage.
Yeah, there's
A lot of cash. This month alone, there was a ton of cash in this office.
Yeah, when they're closing, and they're closing 34.
Yeah.
Can you move it now?
Just think about it. Hey, a cash transaction with no inspections, no appraisal, no due diligence. I can close you in 2 weeks, just get title clear for me.
Exactly, that's it.
It's hard, you know, hard to contest that, you know? So that's still the challenge we run into.
Anthony, let me ask you something
Yes.
before we move on. This paper, would this be, and maybe you guys can answer as well.
Yes,
Is this something you might want
I
to share
would.
with your clients?
I would.
So this way they know.
I'm gonna
Prior
send this
to-
out to
you
the
have a
office.
seller and you're gonna get multiple offers and there's gonna be all these different types of financing. Maybe it's a way for you to educate your clients prior to them getting the offer. So then they're not saying, I don't know what to do. What do you suggest? Sort of thing.
Or
I
even
don't
if
know.
you're holding it,
Yeah,
even
yes.
if you're holding on to it yourself, even just to save it as some talking points and stuff like that, or even just a reference for yourself. I have even more deeper ones with a lot more verbiage on it, but this is like a super slick, easy way as a
Yeah.
reference, and I'll email this out to everybody.
And you still have to, as a seller, you still have to wait 6 months if you're flipping a home for an FHA or a VA.
Absolutely, absolutely. So if it's less than that, need 2 appraisals for FHA.
Okay, so you can do it.
You can do it. You
In
can
the
do it.
beginning, you could.
Correct.
You know, I just want to make sure.
So if you have flip transactions going on, you definitely have to get 2 appraisals if it's less than 6 months from when the property was deeded.
Yeah,
So-
because it's like this, just reading this list, it looks like you need a flip house. There's nothing as you go move in.
Yes and no.
No
So,
chipping paint, no chipping windows, no.
so the big age-old question is the different programs, right? Government, FHA, VA, USDA, and then conventional financing. And why do we accept certain deals? Why do we don't? What the seller gets concerned about? What is a selling agent concerned about? I had sent this out maybe a couple months ago in regards to FHA and like, what are they checking? So keep in mind, an appraiser that does an FHA appraisal may or may not be licensed. Actually, let me do it this way. A conventional appraiser may or may not be licensed to do FHA or government. It's a totally different type of set of laws. It's a different form that's being put on. And as you can see, they're looking for more and more things. I mean, there's a lot of things that are on here that typically they're looking for, but the big ones that we always know, that's the big sticking point with government loans, because this is kind of lumping FHA and VA and USDA also too as well, is the condition of the house. A borrower can buy in a house that's aged and dated from the 70s, but if it's cleaned and maintained, that's okay. But it's the homes that are a little worn, old wood casement windows, paint's flaking off, maybe someone painted the foundation on the house and the paint's flaking off there. The appraiser is going to request those things to be fixed or repaired. The challenge where you run into is on the selling side or a seasoned agent, the first thing they're going to say is, oh God, FHA appraisal, I don't want to be dealing with any concerns and challenges. They can come back to you. And even as a buyer, you could say, listen, if anything comes back on the appraisal, FHA specific wise, maybe as a consumer, you'll pick up the tab and you'll fix those things if the seller's okay with you doing it. You know, hey, I need the house scraped and painted. Okay, I'll take care of that. So at least you're eliminating all those concerns. And this is more the education to your buyers on, listen, there's a stigmatism out there with government financing, okay? It's a great program. You put down your 3.5%. We're pushing the envelope. We're at a 48 debt ratio. Conventional, we couldn't get approved. However, they'll understand something. If something comes back with the property, with some concerns, it might be up to you to fix it. And that might be something we might want to step out and say up front early on if there's any questions or concerns. As a consumer and buyer, to kind of counteract the concern of the seller or seller's agent. Yeah, not us specifically, but yes, but going back to the selling agent saying, listen, I already spoke to my client already. In AR, we could put notes in there or put the attorney revealer, buyer to pick up any appraiser required repairs. Appraiser required. I'm sorry? Yeah, so that's more on the renovation side, a different type of financing. I didn't want to kind of fire hose everybody regarding all that, but this is more your traditional FHA 203B loan, where that's just the acronym they call it, where they're going to check around and make sure the house is in pretty good condition. They don't want to see visual issues or problems. And a lot of times I always kind of rely on you guys to kind of be my eyes. Like, what's the challenge? What's the issue? Is there something I need to be worried about? I just had a deal recently the other day and they told me due to the storm, there was a leak in the chimney. So you had a huge hole in the ceiling where they cut it out. They were dealing with the problem. The roof has been since repaired, but it was a refinance. And he's like, hey, I got a hole in the ceiling. I'm like, whoa, before we even have an appraiser go out there, because what is that going to do? It's going to deem questions on what the heck is going on above us. The appraiser could ask, hey, listen, I'm not a specialist, but we recommend getting a roofer out there to give us a roofer cert that everything is A-OK. So just keep that in mind with these homes and the conditions that we're dealing with. Buyers and stuff may be saying, hey, I'll waive everything and I'm waiving inspections, but the house has to be in sound condition where there's not visual issues or concerns that potentially could put the bank at risk from a lending perspective. And that's where the appraiser is kind of a little bit of the gatekeeper, and they are tougher on FHA appraisals. They just are, they've always been that way. So again, if there's anything you can mitigate on the front end or any kind of concerns, it's worth kind of having those discussions either with seller or buyer so everybody kind of knows what's going on versus not mentioning anything at all and then finding yourself being on the seventh losing end offer because maybe we could have kind of strategized a little bit differently on the front end when making it. And I've had over the years, I've had many buyers on Saturdays going out there and scraping and painting houses. Again, you need the consent from your seller to be able to do this. Where do these deals become challenging? We don't see much anymore, but like bank-owned property foreclosure, the bank doesn't want anybody in the property repairing a house. So again, I think as long as you're stressing that upfront to a seller, hey, listen, if there's an issue with anything repair-wise per the appraiser, not per the inspection, if you're getting one, appraiser requested, I'm willing to take that on. Now you're just transferring the risk from the seller at that point back to the buyer. And I have people doing that all day long, right? Let alone even waiving appraisals and waiving even inspections. But I mean, especially on the FHA financing where people are even waiving inspections. But again, the appraiser is going to be the one that do tell tale when it comes to FHA. I'm not going to go through the whole list, but you can see they're making sure of just the condition of the property is safe. The other big thing besides paint flaking, what we see a lot of, handrails, right? So like you could have a step outside where it's like 3 or 4 steps going to a landing or deck. That could be a problem. It could be a challenge. Things like that you have to address. You got to keep that in mind. Go into a basement, there's no hand railing going down and it's open, 8, 9 steps down. They're going to want a railing put on the other side.
Broken window.
Cracked, broken windows, things like that too as well. Well, I mean, that's a whole different conversation. I'm hearing a lot of chatter around that office, people with their clients, even personal stuff where home insurance, like even though a policy gets bound, there's so much moving parts with homeowners insurance policies, everything these days. People are going online, click, click, click. The insurance companies are doing quick aerials of a dated photo, asking you specific information. And then a lot of times they're doing an inspection finally of the property 2-3 weeks, a month later, and then you get a nasty gram letter in the mail. Hey, listen, we came out and reviewed your property. There's a tree hanging over the roof here. So they're concerned with what could potentially happen to the house. We want that trimmed. If it's not trimmed but within a certain period of time, we're getting a cancellation, right? Conditions of certain things, or can you get this addressed? So those things are happening on a regular basis for folks, but from an insurance standpoint, everybody's just quickly going online and getting their quotes and binding policies because it's such a quick, fast thing. So just keep that in mind too. And this it flows right into VA too as well. It's everything government-wise. They're just a little bit more tougher. They want to make sure with their type of financing that the borrower's getting a sound home because of why? They don't want to have it where all of a sudden there's a problem after closing and they can't do what? Pay their mortgage payment. Well, they can't make their mortgage payments on time because now they're doing repairs on a property. We talk a lot about inspections all the time with people and folks looking for repairs and things to be done all the time, but they're looking for specifically things that are kind of really visual that could be a major issue.
I remember once I had an FHA and the steps in the front were missing a few bricks.
Crumbling and stuff like
Yeah, so
that.
I showed Anthony a picture of the steps and you suggested that it gets patched up immediately.
Yeah.
Otherwise, it's
Get it
not
done
gonna
before
get
the
done.
appraiser. Do the same thing with your sellers. You're going out there and doing your first step, right? And let's say you're out for your second step. I would be really drilling down on them. Like, I know we want to get the house in the market. It's a great time right now. There's low inventory. Why don't you go through that little bit of a list, you know, and kind of really break down what you think may or may not be a problem. Well, you guys are seasoned, you do that anyway. But for some of the new folks, it's worth making sure you're doing that. You see a crumbled stairs, conventional FHA or even an inspector is probably going to pick that up. And that's going to be number one on the inspection request list coming back to the attorney. You want to get all those things kind of done early on so you're not dealing with challenges or delays and stuff like that.
And the buyer was doing the steps anyway, so a real quick plumbing patch job was done. Just
Gotcha.
enough to get us through the appraisal.
Yeah, like tripping hazards and things like that are a major concern. They don't want anybody getting injured or anything, you know, from that. Any questions or anything more on the appraisal issues or concerns that potentially could be when it comes to that? And again, I'll email you all these copies. So again, you could have one of these too as well. So if you're even looking on a property and you're newer, you're not sure, again, you can always bounce something off a colleague or myself because I've seen every appraisal pretty much out there. But at least I can give you an idea, like we might have a challenge, or address that first with your seller before listing, or address it with your buyer that maybe the buyer and seller work out some kind of a deal while they're in attorney review on who's going to take care of that if it poses a problem. So it kind of gives you like a, you know, your conventional to FHA, your government financing, kind of the different options that buyers have. And these are the most programs that we do see. When you start to get into the higher loan amounts, that's jumbo financing. Jumbo financing is its own set of guidelines. Fannie, Freddie, they don't play in that space. FHA doesn't play in that space. Everything over $852,000 now, it keeps changing multiple times a year because the house prices keep going up. It's considered a jumbo loan. All bets are off. Different set of guidelines at every different company, investor out there. We have a bunch of different investors that, depending on the buyer, we could do 10% down on a $2 million house with no mortgage insurance. But you need reserves. They want to have people that have a lot more cash reserves from a risk standpoint. So their debt ratio requirements are much lower than some of the other stuff too as well. Again, because of the risk too as well. I'm gonna have you jump to the other slide too as well. I had sent this out a couple of days ago and we were talking about it in day two. Kind of what's happening in the market right now. Rates have been rising. I talked about it this morning in the meeting a little bit. What does that look like for our buyer? I was listening to a call on the way in this morning, and they're saying that rates are going to be good for a good foreseeable future, but everybody has a different thought process on what good means, right? Like 2.625 is fantastic. Well, we're off of those lows. Now we're creeping into the threes already. Some people might panic and go, oh my God, I missed the boat. I'm not going to buy anymore, you know? Well, those rates are still crazy low, right, Carol? So, I mean, everything we're talking about is rates will stay super low, but it may not be as low as what people want. If that's the case, maybe buying now might make a lot of sense for people. And you can see on this illustration, same house at $350,000 or 20% down, just a 1 point bump in rate from 3 1/8 to 4 1/8, right? Look at the difference in payments, $157 a month. And that's just because of a market, you know, just the last 3 days alone, we lost 75 basis points in rate, about 1/4% in interest rate within 3 days. And that's just because of what happens in the market. That could equate to like $75 a month for some people. It's a lot of money, especially if we're early leverage. We went from conventional to FHA because they're losing out on every deal. They need to offer more. So, I mean, these are all the things that are looming and going around for folks out there these days. And this one especially, I would definitely be dumping this out to like KV Core or your Spear or something along those lines, and just giving people an idea. Like, here, there's been a lot of talk about interest rates rising into next year. I'm not going to go to 8%, but they could go up 0.5 point to a point. That's big. And if that same house that was on the market now that you lost or you passed on over 5 to 10 grand, it could also, with current market appreciation at 4%, be 20,000 more next year. So now you got a rate hike plus 20,000 more. your delta could be $150 a month for different payments. And it's hard to convince people of that, right? So that's always the big challenge. But trying to kind of, put this data together, or leave behinds, or mail outs, or whatever the deal is super critical. Being super informative to folks, I think, is the most important thing that you can be doing with them, because it's tough. A lot of times they're making their own decisions. They know more than you guys do, and you guys are the professionals, right? But I think as long as you have this data and you have this information to them, so you can explain to them, and it shows to them that you have a lot of the tools and resources, much better you're going to be when qualifying buyers and explaining to them why we need to be speaking, or Anthony's validating our sale. That's super important. I was just on another call with someone. I told an agent, send me all your offers. Let me find out for your seller which one to make. Because he was on a conference call. He's like, we're still trying to figure out what deal is the best. Why not give me a call and I'll let you know? Just because that one $10,000 more, it may not be the best. So those things are really. Anybody have any questions at all? I mean, there's so much more that I could talk to you guys about for days and days on end. We have some seasoned people and some new people. Anything that's been coming up in your world, or on a contract or a deal, or you saw something strange or weird, or I never heard of this before? Yeah.
I mean, years ago, we always had to have the test inspection, and the mortgage company always wanted it, but now you don't need that anymore.
You only need it on VA.
On the VA.
Yeah. And unless you specify in a contract you're getting a pest inspection, my recommendation would be to leave it off. Right?
The other thing is like surveys. Now people aren't getting surveys.
We don't require one as a lender, but there are lenders and banks out there that mandatory require a survey. That could be a $700 to $1,500 cost to an additional cost to a client. My emails when I'm working with buyers, when I introduce myself to the attorney requesting title with the mortgagee information and the loan number, is please go over the cost and fees if you're getting a survey with the buyer.
The survey's so important.
So
Super important. But guess what? Sometimes there could be an existing survey from a year or two ago. They can endorse it over to the buyer at no cost. But sometimes people don't do the due diligence to ask. So I got burned many moons ago. So I transfer the risk from me to the attorney, because that's his responsibility to tell the client what the costs are going to be. Because I can't tell you how many times I'm going over costs with a client. He's like, I feel like we're like $750 more than what you estimated. And I'm looking through, I'm like, did your attorney go over what the survey costs were? He's like, no, he never mentioned that. Give your attorney a call.
Well, in septic, do you know that?
VA loans and FHA.
Oh, no.
So your government loans are looking
What was that question?
do you need well and
Well and
septic
septic.
inspections?
well and so.
Years ago, you knew that.
Yeah, it's certain stuff. I mean, I feel like less is always more. Another one that comes up a lot. If you're doing multifamily homes, right? You're in the contract. There's a section there that gives you the tenancy section in the contract, right? Where people get burned is they put all the information about the renters in there. So let's assume we have a buyer buying a multifamily to occupy, right? And they're going to move into one unit and the other one's going to stay rented. But if the contract reads both leases run past the closing date, how is our buyer moving into the unit? Problem number one. And I had a conversation with someone the other day that were writing up a contract with leave it blank. Leave it blank. I don't need to know what's going on or what the arrangement is between seller, buyer, and their tenants. Leave it blank. Because if you leave it on there, the first question the underwriter is going to be is, what unit are we moving into? And I want pictures the house is vacant at closing. Now you got a problem. Because maybe the buyer is saying, listen, I'm going to let them stay another month or two. I'm still planning on moving in, but I'm going to let them go through their lease. They need to find suitable housing because everybody's trying to be nice to us. That doesn't work. So I would always leave that.
And how much of the lease money goes towards your?
75%. So if it's $1,000 lease, not that it's realistic anymore, it'll be $750 that'll be applied to the borrower's income to help them qualify for a higher loan. And you see that a lot. You saw that a lot in the mid-2000s where first-time home buyers were like, hey, I'm going to buy a multifamily because I actually have income coming in the property. We're able to qualify that when people are purchasing. So that's super good. What else? What other questions? I mean, it's great we're finally able to get back into a session again. It's been a while, for sure.
I just want to bring something up that happened with an FHA. In Randolph, I was a listing agent. This was a few years ago, but there was gas in the street and there was water in the street, and this house was oil and well. And an FHA requires
Mhm.
that to be upgraded as long as it does not go over, I think it was 3% or 3.5%. If the cost of doing that does not exceed there was a certain amount. So that's something to be aware of too.
If there's gas in the street and your oil, you have to.
They want you to
Yes,
convert.
you have to convert. So that's something everybody should know, because we did not know it.
And if you
FYI.
even look further west, there's even challenges when you have well and septic, distances apart
Oh,
from each
yeah.
other. I think it's, I forget exactly what it is. Apart from each other.
On some of those lots.
Yes,
they're all 40 feet.
sure. But there are things that they make exceptions on too as well.
But like the seller was like, I don't want to pay that expense. The buyer's taking advantage of that, not I,
That's
I'm
where the whole
leaving.
FHA
And then the,
company
yeah,
comes
and then
in
the
they
buyer
might
was,
kill the
yeah.
deal and run a conventional
Buyer was like, I
buyer.
don't have that extra money. I wasn't expecting to pay that, but it actually exceeded the amount, so they did not have to do anything, so it ended up working out.
Decision if you have multiple offers,
Sure.
or like an FHA, gas in the street,
Yeah.
oil, that's like a no-brainer.
Yeah.
Is that an always?
Yeah, yeah. You don't see it too much like this way, but as we head out west,
Can they check that? The bank checks on that, or is it?
appraiser.
private?
the appraiser.
The appraiser. Okay.
So the challenge you run into is it's further down the road in the process, and all of a sudden it's like appraisal comes in, you're like, oh shoot, and I got to drop that bomb to someone going, hey, this is available on the street. Can we kind of get an idea from the town what the cost? It's a big expense. Yeah, it's a big
Mhm.
expense.
Took it out.
Right. It's not,
Yeah.
not
Which
too
is why it
far.
exceeded the amount, which was the good thing, or the percentage of that, yeah.
But sometimes, believe it or not, it's not that bad for whatever reason. Maybe based on either where it's there, how close it is, and stuff. What they currently
Well,
have.
the getting it there is not very sure. So
Right.
much is changing.
Yeah.
Yes.
We were talking in our office before about attorney.
Mhm.
Because, the title company seems to be
Still only
doing
secret.
most of
The
the
settlement.
work.
Okay.
Right. Title company seems to be doing most of the work. Can you just tell us, what does the title company actually do? I know the attorney, they're just checking to make sure it goes through attorney review and maybe taking care of some of the issues with the inspections. But other than that, isn't most of the work done by the mortgage company and the title company?
9 times out of 10 right now, when you put your borrower into attorney review and align them with an attorney or they're aligned with an attorney, your attorneys are reviewing all the contract, right? Going through everything, making sure they're protecting all parties involved. Then they're sending out their letters to make sure everybody's in line. And then you close attorney review. At that point, it's really on me to get really rocking and rolling. And truthfully, I try to get going as they enter attorney review because it buys me an extra few days. Because if the attorney review is taking 2 to 3, 4 days, I can get the loan in, get the loan disclosed. And actually at that time, hopefully an appraiser is reaching out to you. So where almost the timing where the inspections are being done, the appraisals getting done on the heels thereafter that, and then we're getting the commitments rather quickly. Because in the market that we're in right now, appraisals are taking forever. They got hit with IDA. They had to go back to every single house and re-inspect all these properties again. So they're ready to kill everybody because it's taking forever on that. I'm still getting dribs and drabs of appraisals coming back. But with the question regarding that, the challenge you run into is just the way the market is from a dynamic standpoint and how that's kind of laying itself out. I'm losing my train of thought, sorry.
I do that.
So with title, they're ordering title. I usually tell them what they need to do. They send a message to either Megan or Ashley, especially if it's an attorney that's doing business with us on a regular basis. And then the title comes in 3 to 5, 7 days later. I get a copy of the title policy. Like you said, Carol, at that time too as well, the attorney's working with the other attorney if there's any kind of inspection concerns or issues, at that point. And then really once I'm issuing the clear to close, the settlement agent for the most part is actually doing the closing. So we're working with the title company. They might have their own settlement agent, or we might be partnering with another settlement agent, and we're balancing the final figures. The attorney many moons ago would actually physically do the closing with the buyers, but that's like a lost art. You don't see that anymore. So what's happening is there's an additional fee, there's a settlement fee, and the settlement agent is actually doing the closing. A lot of the attorneys are there for any questions that a borrower may have, but they're not there reviewing all the documents, settlement agents.
The title- title
Attorney's
right,
still getting the
right,
same amount of money.
Well, remember, we're,
Sure.
not every state has attorney review. It's
Right.
very rare that people do have attorney review.
Everything
States.
north, everything, I've said this times as well, everything north of the old Driscoll Bridge inherited all New York law. New York, they had where the attorneys are. So everything in northern New Jersey we see, like Union County and up, everybody's using attorneys. But as you get south, they don't use attorneys. The title company.
And it is
Everything.
very easy not to use
Much
it. I have to
easier.
say, it's much easier
Pennsylvania,
not to
they
use
don't use attorneys. Florida, they don't use attorneys. South Jersey, they don't use attorneys. It's a lot smoother. You don't get that clawing back and forth.
Well, most
Title
title
company.
companies run by two.
Yes and no, not always, some are.
Does your client get the same protection, whether it's the title company or an attorney?
So that
Yeah,
would probably
I
be an
know,
attorney
know.
question, or a title company question. I mean, there's no attorney review period. Like down in Florida, the agents actually
Yes, they
work
have
all
around
that stuff
everything.
out and it's done.
Yep.
So it's kind of like, soon as you sign, they put all their stuff together and you're done. There's no of like, I don't know, I'm not really sure, or back and forth. And it's very interesting on how that stuff plays
So
itself
if
out.
there's an inspection issue, the realtors hammer it out.
And just think about that. That's a totally different dynamic, where usually right now, we kind of interject, but we step really out and let the attorneys, let your attorney handle it, you know.
Yeah, but when I bought a house in Florida,
Yeah.
I actually thought what was going on. It's a mistake.
Right.
I was like, my husband goes, you didn't catch that. Who was that? I go, nobody.
Right.
Nobody, because you have to do the paperwork yourself. The title person is actually working to sell it, right?
Right.
So, you just have to trust.
You said title company is working for.
They work basically for them, but they're getting you to sign. It's weird. It's weird.
There's a lot less questions when you're dealing with that, because there's a lot less heads in between everything. But like you said, there could be some potential concerns, because who's double backing or triple checking and things of that nature. But like the Missy said though, because of the lack thereof that, things kind of go a little smoother that way. Because there's no one looking to kill a deal or anything like that.
And so our contract spells out that once everybody has received a fully executed contract all the parties involved, attorney review starts. And so attorney review then is 3 days from that time, and then it ends automatically. So as long as nobody, has any problems with anything, and most of the time you've agreed on everything, right? Up to that point on the contract, that's why both parties sign. So then you're automatically in attorney review in 3 days. Without attorneys. Yes, without attorney, yes. Yeah, because here, what happens is, right, the attorney disapproves that contract, and that
Correct.
contract is null and void, basically, and that, yeah. Or they don't answer, right?
All the above though. I mean, next thing you know, guess what happens while we're in the discovery stage, our offer comes in. Because so-and-so wasn't available to get that letter out, or you wanted to change a date, or what do you mean there was appraisal contingency waiver? I don't agree with that, Mr. Seller, we gotta change that. And everything that was agreed to on Sunday is out the window on Wednesday, and now you're looking for another buyer. What else? But I mean, we can kind of take this even deeper on something else, whether we get more ingrained or specific on a certain program or type. But I mean, this kind of gives you just an overall, again, as far as the programs.
This was really great, and this is really great. All these resources are excellent.
So you can send us out.
Yeah, I'll email you all.
This is even good for step one, just pick
Right.
out a few things, like really learn them, so you have confidence when you say it, and when you say that. step one.
And the other thing too, about when it comes to mortgage stuff, with that, Lori, try not to overstep too as well and kind of get real deep into mortgage stuff. Because I've had it at times where someone's like, oh, so-and-so told me this. And I'm like, well, that's not totally correct. Now, like, there's a question going on between myself and the agent's relationship, right? And why is she saying that or he's saying that if that's not the case? So definitely try to always say, listen, perfect information. I hear Anthony's name's on it. Give him a call. I'd be happy to answer your question. Especially if we're representing the selling side, we want to protect them as best we possibly can. So we can make sure they accept the right offer, especially.
I'm going to simplify all your lives. Just send them right. Just get them in touch with Anthony ASAP. That's it.
And then you can just go get someone else.
Yeah, and then work on your next client.
Right.
Move on to the next one.
I was gonna say, Anthony, it's so nice to see all these people.
Isn't it great?
in the
Look
office.
how many people are here.
Um,
What's that?
Everybody's so great.
Yeah.
No, but I mean,
Yep.
meant to say, I think it's great.
It's awesome. I've been dying for this.
I'll definitely email these out to everybody. If you guys have any sidebar questions, grab me, email me, whatever I can do to help.
So you want to be grabbed?
Always. Kelly, see what I gotta
You said just grab me. I'm like, okay,
do?
no,
Hold on a second, hold on.
He'll walk me over.
Hello, HR.
But thank you, I appreciate it.
Thank you. Absolutely.
Yes.
I'm glad Missy told me to get it from, was it Maggiano's you said?
Yeah,
Salad.
Maggiano's, yeah.
Maggi-
That salad
The
is-
one by TJ Maxx on in Hanover, Cedar Knolls.
So that's
Thank
what I
you for
originally
coming,
thought.
guys.
Wow, I'm at a restaurant, right? They shipped it all the way here from Richmond.